Good morning, everybody. Let's start with another topic, savings and investment planning. Now you know exactly now what is savings and now what is investment and why you have to plan. Now I will tell you in brief why it is savings is important. Savings provide safety net in case of emergency. What is savings? Savings is what? It's a small amount of money you keep aside for in case of emergency. In case of emergency. In an unforeseen circumstance, it offers financial stability. It means that during any unforeseen emergency, like you can say any emergency, like health emergency, any circumstance require, any incidents happen, you need financial stability. You need savings, which savings offers you financial stability. Again, you have to keep at least 20% of your income, at least 20% of your income in savings. Okay, so this is what it is very much helpful. Then you can say that the process is easier to handle when there are specific saving goals. Okay, now we have learned much more about savings. Now we learn about options for investments, where you can invest and where you can invest, types of products, financial products you can invest. You can invest in stocks, you can invest in bonds, you can invest in mutual funds. Okay, though they carry a larger risk, stocks will give you high yield returns. Like as I said earlier, high risk will give you high returns. If low risk will give you low returns. So you have to choose those investment which suits a level of risk tolerance. You have to choose those type of products or options for investment, which is your risk, which you can tolerate your risk. Okay. Then next is what? Risk and investment return. Again, same I had told earlier, risk and investment return, higher the risk, higher the return, lower the risk, lower the return. Again, how much risk can you afford on the investment? It all depends upon your risk tolerance. Okay. Then you have is risk management and insurance planning. Till now we have done about financial planning. Okay, this is also a type of financial planning, but this is another type of financial planning, that is risk management and insurance planning. Risk management and insurance planning. Nowadays, when you make a financial plan, when you have a financial plan, you have to first consider a basic and important element is risk. Risk is again plays a very much important factor in your financial planning. It is a possibility. What is risk? It's a harmful suffering. Risk is a harmful suffering or financial loss. It results from number of things, including accidents or health problems. The different kinds of risks that you encounter in our life, the different types of risks that happens in our life. And when you want to after recognizing these risks, you should know what type of risk you need to cover and etc. This helps you to reduce your risk and make financial plans. Next you have is insurance and risk management. What is insurance? Insurance again is safeguard. You can say it's a safeguard against unanticipated circumstance. It's a safeguard against an unanticipated circumstances. It assesses and pays for lost wages, property damage, and medical expenses. It means that suppose you have any health issues, you have been admitted in the hospital. If you have taken any health insurance, then the insurance company will repay you or will cover you through this insurance medical expenses. Okay. Now you can say the different types of insurance. There are different types of insurance. You have is health insurance, life insurance, and property insurance. What is life insurance? What is life insurance? Life insurance means it's a financial support to beneficiaries after death. Suppose if any one of the members in family due to unforeseen circumstance dies, then his next person in after him, the legal heir, will get some financial support. This can help cover debts and provide income replacement. Then you have is health insurance. Health insurance means what? It covers medical expenses and healthcare costs effectively. It is essential to have coverage to avoid high bills. What is health insurance? Health insurance means those it helps to cover those medical expenses and healthcare cost and to avoid paying high bills because they cover your expenses. Property insurance is what protects assets like homes and vehicles from damage or loss. Suppose one day you get fire occurred at a place at your house or any loss incident happened that your any furniture damaged, or it just had an earth and there was an earthquake where your building just fell or got destroyed. So what is this? It's an insurance. Property insurance means an insurance is covered against such losses. So the insurance company comes and gives you claim against these losses. Okay, now this is what is your your risk management. Next, we learn about tax planning. What do you mean by tax planning? Tax planning again plays an efficient role in financial planning. I guess we had done this earlier. What is tax planning? Tax is what? It's a part of your income paid to the government, and this all depends upon your income, total income. So to reduce amount of tax to be paid by the government, you have to start doing tax planning. Tax planning, it maximizes your savings and reduces your tax obligation. Means it increases your savings and it reduces your tax obligations. Now, what are the fundamentals of tax planning? Planning for taxes entails devising legal strategies to lower taxes. See, okay, you can do this. Then tax advantages investments. Nowadays investors or individuals or assessees, what do they do? To avoid tax payment or to reduce the tax payment, what do they do? They take tax, they make investments in tax savings investments. They do tax saving investments so that they get tax benefits that may be advantages to them. Through this, their savings will increase, their investment will increase, and what will happen? You tend to pay less tax. Okay. Then you can see there are a lot of tax saving strategies. Several strategies can help you save on tax effectively. Now, if once you consult a financial advisor, or if you have any, or you are financially literate, then you can automatically have a tax saving strategy. You make strategies how to save tax. It normally an assessee who is not financially literate, then he has to consult a tax professional for personalized advice. Understand the tax implication for setting investments to optimize the outcomes. You have to understand what are the implications of tax. What are the implications on tax on your savings if you sell your investments? So, what is the implications once you sell your investments? Because once you sell your investments, you have to pay tax on your income. So, how to save your tax on the income you earned? Okay, this is what strategies you have to make while doing financial planning. Then you have retirement planning. What is retirement planning? Again, once you start doing financial planning, you have to also take retirement planning into consideration. Retirement planning is essential for financial security. It ensures you have sufficient funds for comfortable life. Once you plan that I want to retire after a certain age, once I cross 60, suppose, then you have to know, okay, after 60, I will not be working. So there will be no regular income of inflow of income. So then what to do? Then you already have a backup plan. What is a backup plan? Retirement planning. You've already made a plan for retirement. So you have to use that now sufficient funds for your rest of your life. Okay. Then you have what are the importance of early retirement planning? Again, same it is what I just explained. Then you have different types of retirement planning, like you have pension plans and provident funds. You have retirement then you have what is pension pension plans. What it is, it provides a steady income. It provides a steady income after retirement. Means once you retire, your employer gives you what pension every month, or every month you get a pension. So this what these plans often require contribution to their working hours. Like once when you are working, you have always need to contribute some amount of money from a salary as pension, and once you are retired, this amount contribution is paid back to you after retirement. Okay, once you retire, you can say once you retire from the company, they this then you have provident fund also provides a retirement plan of a way to save for retirement. They combine an employer and employee contribution to build savings. What is provident fund? Provident fund was what do when you're working, when you are working in a company, when you get a salary, few percentage of your salary from that the employer and employee will contribute from your income to the company. And once you retire, they pay back to you once you retire as provident funds. Okay. Then you have is retirement corpus calculation. Once you retire, you have they even see calculating a retirement corpus is essential for effective planning, because once you know how much I will get after my retirement, you can plan effectively. Considering the factors like lifestyle expenses and etc. and longevity. What amount do you need to retire comfortably? It all depends upon this calculation. Calculate your retirement corpus. Then what is estate planning? Estate planning is what is vital for managing your legacy. It means it ensures your assets are distributed among according to your wishes. Estate means what? It's what you have to ensure that you have that how much assets do you have. First of all, you should know total number of assets you have, what assets you have. After that, you should know how to distribute your assets accordingly, and explore your estate planning and its importance. Okay. What is estate planning? Estate planning involves preparing for distribution of your assets. It includes your wills, trust, and beneficiary designation. What happens to your assets once you pass? See, once you pass away, what happens to your assets which you have purchased? So you should know how many assets you have, and after knowing that, you should know how to distribute the assets towards your legal heirs. So this ensures what? Effective estate planning. Effective planning ensures wishes are followed precisely. It helps to minimize estate taxes and legal complications. Estate planning is essential for protecting your loved ones for financial future. You can even give it to your your legal heirs or your children for your further future, financial future. Okay. Then you have is emergency fund planning. Emergency fund planning is what? Again, it's like it's a savings type which fit into financial planning. It's again a savings type. It's a crucial component for your financial stability and emergency fund. Emergency savings guards against anticipated cost. Means emergency savings, whatever you have saved as an emergency fund, it protects you against against an unanticipated cost. Means any unexpected cost might incur. So this is what and emergency savings. They offer comfort in times of crucial turn. Means they help you in your crucial time. Okay. Now you should know. Now I will tell you about debt management. What is debt management? Debt management is again an essential part for your financial stability. Managing debt helps effectively reduce your financial obligations. It helps to manage your financial stress. It helps to reduce your financial stress. See, you have to understand debt. Okay, you have understood what is debt, but you have to understand even what is good debt and what is bad debt. You should know how to differentiate a debt between is it a good debt or a bad debt. Debt can be classified into two types: bad debts and good debts. Good debts are those which helps to build your wealth. What are good debts? Goods or debts are those which helps to build your wealth, like mortgages. And what are bad debts? Bad debts are often what they arise with high interest credit cards. High interest, like example, credit cards. Because in credit cards, what is credit card? When you open an account in the bank, banks provide you a card, means a credit card where you can purchase any amount. You can purchase goods or make payment through this card, and on this credit card is what basically a bank is paying on your behalf, and after a month, after cycle period, you have to pay this make payment to the bank, and once you don't before the due date, and once you don't make it, you have to pay a high interest on it. So this is what again a bad debt. Okay, so you have to make also debt management in your financial plan. Now, what are the strategies for managing debt? What are the strategies for managing debt? You have there are many strategies. You approach a momentum as you pay off debt. Alternatively, you use debt evaluation method, etc. Then you have debt repayment plans. Creating a structured debt repayment plan is again essential. When you have taken a debt, you have to make plans to repay. You have to repay it. So once you have to repay it, you have to make plans. How will you repay? From where will you repay? And when will you repay? So and how much will you repay? So accordingly, you have to make plans so that you are repaying your debts, you're spending, you're satisfying your wants, you are savings. So this is what a budget, you can say a plan for your financial stability. Then financial planning for different life stages. See, once when you when you finish your college or school, when you finish your college, you know you have to start making financial. Your parents, when you're born, when you are born, your parents already start making financial plans for yourself, for you. So then, but now they have to start making financial plan at an early age, like when you're in 20s. So you start so that as and when you reach in 40s, 50s, you have some sufficient amount of money in your hand. See, early there are three types. There are different stages: early career financial planning, mid-career financial planning, and pre-retirement planning. Early career means what? It means that once you start your career, you have to, in your early career, what you have to do, focus on building a strong foundation. Start by budgeting and saving regularly. Once you start earning, you have to I have to start doing my financial planning. For that, you should have a strong foundation. You start with a small amount, small savings. Then then establish an emergency fund and save for a small amount for a retirement basis. Okay. Then you have is mid-career financial planning. What is mid-career? Once you start your career, you reach like after 2-3 years, or after 5 years, you reach in a mid-career, means in a middle of your career, you have to focus on your financial planning. How? You focus on once you started your planning, focus on growth. How will you increase the planning? Your wealth, your expansion, etc. Your income may increase. How can it happen? Your salary or income may increase. You will get more opportunities. Your spending will also increase. But how to manage your spendings within your income so that you can even save? Then you have is pre-retirement planning. What is pre-retirement planning? Pre-retirement planning is again a very much important. Once you when you are about to when you are in a mid career, you will be retiring after 10 years, after 15 years. But after retirement, what will you do? How will you manage your lifestyle? So you have to from now only you have to start your pre-retirement before retirement planning so that after retirement, like once you retire, you are not without money. You don't know what to do. Okay. Then you have post-retirement planning. Post-retirement planning is what? Once you retire, you have money in your hand. You have to focus on preserving and managing the assets. Ensure you have a withdrawal strategy to maintain your lifestyle. You know every month I get this much pension of suppose 50,000 rupees. How much you have to withdraw from that and how much to save for next year, for next month, it is uncertain. That is why. Then you have to review and update the financial plan. Once you've made all this financial planning, you have to always review and update it because life changes and impacts of well, once your life starts changing, you have an adverse impact or a adverse or a good impact on your financial situation. It all depends upon your updates. See, importance of regular reviews. Once you have to have a regular review. You know what changes in your life is happening, which can affect your planning. Major life events like once you are 20 and late 20s, you will get married, or afterwards you'll have children. So you need money, you need funds. So accordingly, you have to update your, review your wealth or financial planning. Adjust the plan as life circumstance changes. You have to adjust the financial plan as per the life circumstance changes in your life. Once you do that, to track your financial progress. Once you start tracking your financial progress, you know where you stand. You can even make changes if you want. Then you make some common mistakes. What mistakes you make in financial planning? Sometimes there are typical errors you make in financial planning. Lack of proper planning. Sometimes you just make in a hazardous way planning, which you don't know, might know, not realize now, but after a certain point of time, yes, you may realize. Then making a plan in advance can greatly help your financial condition. Make sure your goals and success strategies are well defined. One of the most important element in financial planning is inflation. Inflation is again, it can inflation say every day inflation increases or decreases, but normally it only increases. And once inflation increases, it can erode your purchasing power over time. Once inflation increases, your spending will also increase. Once your spending increases, your savings decreases because you tend to spend more. And through this, the saving decreases and you will not have much funds available for future. So you should never ignore inflation while financial planning. Then you have is overlooking emergency funds. Again, emergency funds are very much crucial for financial security. What happens if you don't save for for emergencies? You have to you save, or else you will take debt, you will take loan. Let's say you will pay through credit card, which leads to debt. Again, you always have to prioritize emergency funds to protect an unforeseen events in your life. This financial planning and tools and resources I will now explain in my next video. I hope you understood all this. Now, if you have any queries, please comment on it, and please like, share, and subscribe to the video. Thank you.